As we dive into the presidential debates, taxes will take center stage, with each candidate showcasing their financial plans for the country. While taxes are a hot topic, they impact us all, especially our investments. Well, what does a change in corporate taxes really mean for the stock market? Let's dive in and take a closer look. The ups and downs of tax rates. Corporate tax rates have swung wildly over the years, influencing the profitability of major companies and subsequently their stock prices. Remember the 2017 tax cut that dropped corporate rates from 35% to 21%? This significant change brought the U.S. closer to the average rates of other developed countries. Now, with talks of raising these rates again, you might be wondering what that means for your investments. Take a look at this chart showing the highest marginal corporate and individual tax rates since 1913. As you can see, both have fluctuated significantly over time, with the top bracket corporate tax rate peaking at 52.8% in the late 1960s, but broadly declining since then. The bigger picture of corporate taxes. You might think that changes in corporate taxes would dramatically shift the market. However, history paints a different picture. Corporate tax revenue has drastically decreased from 27% of government revenue in 1950 to just 9.4% today, while individual taxes have remained a substantial part of federal income. Check out this chart illustrating the breakdown of federal tax receipts since 1950. This chart highlights the decline in corporate tax contributions and the rise in social insurance and retirement receipts, showcasing how other taxes have compensated for lower corporate tax revenues. Politics and market performance. Tax policy is important, but it's not the only factor driving market performance. Historically, the stock market has performed well under both Republican and Democratic administrations. Regardless of their tax policies, market returns are driven more by long-term business cycles rather than short-term political changes. See this chart showing the growth of the S&P 500 under different administrations. This chart highlights that markets have thrived under various tax regimes and political landscapes, just demonstrating the resilience of the market. So what should investors like you do? Amid the political noise and proposed tax changes, it's crucial for investors to stay focused on their long-term goals. History shows that markets are resilient and companies quickly adapt to new tax laws. If you're concerned about specific tax policies, consulting a trusted advisor, like me, is always a good move. The bottom line, as the election season heats up, expect corporate taxes to be a major talking point. However, the key for investors is to keep a broader perspective and stay committed to your investment strategy. The best way to achieve your financial goals is to stay invested through the political and economics ups and downs.